friends, my name is Richard Bell and I am a realtor with Remax Crest Realty here servicing the Greater Vancouver area. Today's hot topic is on buying a pre-sale. In recent years, we start to see many home buyers purchasing a pre-sale unit as a way of investment. They're hoping to sell their contract before completion in an attempt to gain in profit should the market go up. However, not every single pre-sale development will yield the same type of return. There are many factors that you need to consider as an investor. So today we'll go over some of the factors that you need to think about in order to help you make a better judgment. So the first thing that you need to consider is the deposit amount. For most pre-sales in Vancouver, developers will require buyers to put on a deposit that is equivalent to 20 or 25% of the purchase price. However, in some rare cases, the developer might allow a buyer to put on a payment that is as little as 10%. Having less money locked into a developer's trust account will allow the buyer to have some extra cash to invest into something else, hence diversify their investment portfolio and lower their overall investment risk. And the next factor to consider is your holding period. How long are you planning on holding on to this contract before selling it for a profit? Because that might significantly impact your return as well. A good indicator to look for is your compound annual growth rate, which is the mean annual growth rate of an investment over a specified period of time longer than 1 year. This will give you a better understanding of how your pre-sale investment will perform against any other types of investment opportunities. And the third factor to consider is the assignment fee. Is there an assignment fee to be paid upon selling a contract? Who is responsible for paying for this assignment fee? The assignor or the assignee? On top of that, is the assignment fee expressed as a percentage of the selling price, or is it a fixed amount? Next, we have the assignment term. When are you allowed to assign your contract? In most cases, developers only allow their purchasers to assign their contracts once the projects are sold out. However, in some rare cases, a developer may allow his buyer to assign his contract once a certain percentage of sales has been reached. For example, a buyer may assign his contract once 80% of the project is sold. Next, we have the GST amount on your profit. The bad news is many buyers are not aware that the profit made on an assignment is actually taxable, and the total amount is dependent on the tax bracket that you're in for that year. And the next question to ask yourself is, are you going to assign your contract before completion or sell it after completion? Very often, the market doesn't rise as much as buyers had anticipated when they first purchased their unit. If a buyer doesn't see enough room for profit before completion, sometimes he or she might choose to close on the deal. If you are going to close on the deal, here are a few things that you need to consider. First of all, you need to be able to secure a mortgage from a lender. Secondly, you gotta make sure you have enough money put aside to cover the property transfer tax. Although sometimes a lender might agree to put the GST amount on top of your mortgage, it is unlikely that a lender will loan you the fund needed to pay for the property transfer tax. And now, what if you are unable to assign your contract before completion? Are you able to afford all the costs related with owning an investment property? First of all, think about closing costs, which include lawyer's fee, conveyancing fee, as well as all the fees associated with ordering documentations from the land title office. Next, GST is payable on a pre-sale unit, which is calculated as 5% of the total purchase price. However, if you are a first-time home buyer, you might be qualified for a GST rebate from the city if your pre-sale unit is under a certain price point. Next, we have the property transfer tax, which is calculated as 1% on the first $200,000, 2% for the remainder up to $2 million, and any amount over $2 million will be taxed at 3%. Next, insurance premium. If you're planning on renting out your unit, you have to purchase tenancy insurance to make sure that your property is securely covered. And lastly, we have your mortgage payment as well as your strata fees. So if you're planning on renting your unit after completion, how much income can you generate monthly? Is it enough to cover all your expenses? These are some of the questions that you have to ask yourself. The most ideal situation will be having positive cash flow monthly from renting out your unit after paying off all the expenses. However, in most cases, investors are only looking to break even. In my opinion, even you have to take some money out of your pocket to cover some of the expenses every month, as long as you can afford all the carrying costs, real estate is always a good investment in the long run. As always, my name is Richard Bell, realtor with Remax Crest Realty. If you're thinking of purchasing a pre-sale unit as an investment or thinking of selling your current contract, please give me a call and I'll be happy to have a chat with you. Until next time.